Options trading is an alternative way for investors to invest in the performance of a security, such as a stock or an ETF. By trading options, an investor can capture the up or down movement of a security while only investing a fraction of the cost it would take to own the actual security. For example, consider a stock that's currently trading at $100. If you purchased a share and the price went up $5, you would have a 5% return. With the right option contract, you could profit from the same jump in the stock price while only paying a small premium that costs significantly less than the price of owning the stock. Additionally, your returns could even be greater than 5%, depending on the option you purchased. The ability to make more with less is one of the benefits of options trading. However, the potential for greater profits comes with greater risk of losses. To help you understand why, let's take a closer look at how an option contract works. Unlike a stock, when you buy an option contract, you're not purchasing the security itself. Instead, you're purchasing a contract that gives you the right to buy or sell a security at a certain price before a certain date. Consider this example. Suppose there's a coffee shop chain called Stone Curb Coffee. Stone Curb stock is currently trading at $50 a share. An investor believes that the stock price of Stone Curb will rise. This investor could buy the stock, but she wants to be in a position to take advantage of this anticipated price movement. Now let's assume that there's another investor. He already owns 100 shares of Stone Curb stock and plans to hold on to it for a while. He thinks that the stock price will not increase much over the next few months. Both investors can benefit from a call option. This type of option contract gives our first investor the right to buy shares of Stone Curb stock at $55 per share in 4 weeks' time. Typically, each option contract represents 100 shares, so this one contract would give our buyer control of all 100 shares of our seller's Stone Curb stock. Our buyer pays a fee for the contract, which is called the options premium. The price of a premium is determined by several factors, including the stock price, time, and implied volatility, which is how much the stock is expected to move during the life of the contract. For the seller of the contract, this premium can be a nice payday, but also helps to offset the risk of losing the stock. For this example, let's assume the premium is $100. Our buyer pays the $100 and purchases the contract. Now let's examine what could happen to this investment. Suppose our buyer's instincts were right, and Stone Curb stock is now selling at $60 a share. Remember, the call option allows our buyer to purchase shares of the stock for $55 a share. One buyer could purchase each share from the seller for $55 and then sell it at market value for $60, making a profit of $5 per share. Because an option contract represents 100 shares, our buyer's contract is essentially worth $500. If our buyer sold her contract, she could potentially make around $400 in profit. The value of his contract minus the $100 premium she originally paid for it, as well as any commissions and fees. While the buyer's investment paid off, things didn't work out so well for our seller. Although he was able to collect $100 for selling the option, he missed out on a portion of the stock's profits and now no longer owns the stock. Now let's rewind. Suppose the stock moved in the opposite direction and is now selling for $45 a share. Our buyer's contract gives her the right to purchase shares of Stone Curb for $55 a share. Because no one would want to pay $55 for a stock that's selling at $45, the buyer's contract will expire worthless. Our buyer is now on track to lose 100% of her initial $100 investment, plus any trading commissions and fees. For our seller, the option expiring worthless is good news. He still owns his shares of stock and made $100 selling the option. Although the value of his shares declined, he was able to earn a little additional income from the option premium, less any commissions and fees for selling the option. Keep in mind that this is a simplified example. The pricing of options is very complex, which is why it's important to educate yourself about options and their risks before you invest. While the biggest change comes from the price of the stock, ETF, or other investment vehicle that the contract represents, there are other forces like time decay and implied volatility that influence options prices. While we showed you one example, options can be used in a variety of ways. There are call options, which we just saw, that are good to own if the price of a stock goes up. And there are put options, which are good to own if the price of a stock goes down. Calls and puts can also be combined in a variety of ways. By buying and selling these options, investors have the potential to make money when the market moves in any direction and create strategies with a variety of risk levels. Because of the risks involved, we recommend that you learn more about options before making any trades. If you are ready to start learning more, we're here to help. Take control of your financial future today